good evening. Thank you all for attending the Big Picture Investment Club meetings. These meetings are meant to give you information and education. And tonight we're going to be talking about investor financing options. We're going to be talking with Steve Mormon. He's with USA Mortgage, and we've worked together for several years. I refer all my clients to him if I have opportunity. He's great to work with. So if you have any questions, please don't hesitate to ask. We're here to answer questions about financing options, including 1031 exchange. We will have the chat box open. If you have questions, you're welcome to do it that way, or raise your hand, or if there's a break in it, you can shut up or turn on your mic and talk. So without any further ado, here's Steve Mormon.
All right. Welcome, everyone. Well, as a show of hands, or if anyone wants to chime in, how long has everybody been doing investment property? Is this working with first timers? Are we working with seasoned people? And I just wanted to kind of get a feel for how people are currently financing these investment properties.
First timer with Jill.
Okay.
This is Linda.
Awesome.
8 years.
8 years. Wow.
I started with Jill in one of her classes.
That's awesome.
I guess I've been doing it about over 20 years.
Awesome. So with doing it for this 8 to 20 years, are you, Eric, how you doing?
Hey, good to see you.
What's your level of seasoning on investor properties?
Novice.
Novice, okay.
I'm not, yeah.
Okay.
More of not super active, just investing right now. Kind of a
Okay.
hard money.
So for the seasoned ones, are you using like your own money? Do you have hard money lenders? What are we currently doing?
So I guess I've used either my own money or money out of properties.
So cashing out of some of your other investment properties and using that?
Yeah, either cashing out or just taking equity out of the property.
Okay. Okay. Well, great. Well, I'm not going to speak on any of the hard money stuff because that's not what I do. I don't do hard money lending. So you guys, if that's what you're using, that's great. This is for other options other than hard money if you wanted to do something else. So now when I'm talking about conforming, we're talking about Fannie Mae and Freddie Mac. You have to have, good credit scores. Your debt to income ratios have to be good. You only can do a certain number of properties through them. And then everything else is called non-QM. Right now, we're just talking about the differences between conforming and non-QM. Non-QM is everything outside of Fannie Mae and Freddie Mac. And, with the non-QM, it used to be, well, now it's called non-QM. It used to be called subprime back in the day. Now, then that went away when the market crashed, and now it's come back as non-QM. And, some similarities, some differences to it, but we'll go through some of the different programs there. So first off is the Fannie Mae and Freddie Mac. Again, if we're going to analyze each of these, you're going to get the lowest interest rates through a Fannie Mae Freddie Mac deal. Either lowest interest rates or lowest points or combination of the two would be through these programs because those are backed by Fannie Mae and Freddie Mac, and they're going to have kind of that lowest rate possible there. Now, to do that though, you have to have all of your income and asset documentation. So if you've got 20 rental properties, you're giving me all your tax returns with all the Schedule E's, rent, leases, everything. To get through on one of these loans. And they're going to cap you on the loan to value and also on purchases and then cash out refinances. And you do have a maximum of 10 properties that you can be financed through Fannie Mae and Freddie Mac. Also, the big kicker, you cannot close in an LLC. Now, some, lenders might say, well, just close it in your personal name and then flip it to an LLC. You don't want to do that. There's a high probability that investor can and more than likely will call that note because now you've changed the deed. Anything that changes the deed is a note calling feature. So you know, that's the downside of going Fannie Mae and Freddie Mac. You can't put it in your LLC. So again, the biggest downside to this is you cannot close in an LLC. Now, I have heard, you know, some other people say, well, I'm okay with putting it in my name personally, but to protect myself from a renter possibly suing me, I'm going to get an umbrella insurance policy. So you could do a 2 million umbrella insurance policy, close in your personal name, and that would be your buffer from getting sued personally and them taking your home. Because, you know, I've also heard that even with an LLC, that when you get sued, that can be pierced and they can still come after you personally. So talk to your insurance people and those if you want to see whether or not that makes sense to go personally versus an LLC. First option, I would say, in terms of, again, lowest cost and best interest rate would be a home equity line of credit on your primary residence. Okay, most of the time, next to no cost involved. A lot of times they'll do it for free, maybe pay for your appraisal, and then you can pay cash on your property, use that line of credit to do the renovations. If you're going to flip it, then you can pay it all back and just kind of keep churning that. Also, by doing it this way, you're going to be able to put that new property, an investment property, into an LLC because you paid cash for it, right? Now, from a tax purposes, you know, you want to talk to your tax professional about, you know, you taking out a home equity line of credit on your personal, and now did you give yourself or your LLC a loan because you paid cash on this property? So how are you writing off the mortgage interest on your primary residence on an investment property? I think there would have to be some sort of a document that says your LLC borrowed that money from yourself in order to make that, you know, somewhat legal there. But again, talk that over with your tax advisors. And then, you know, that would be another thing. We'll need to retain all documentations, you know, in terms of tying those funds to this investment property for those tax purposes. That you use the line of credit purely for that investment property. You wouldn't want to, you know, be using this funds to, you know, pay off some personal credit card debt and then, oh, I also, you know, financed this investment property in the renovations, because then it's going to get very tricky on, well, how much of the home equity line of credit are we using for the purpose of the investment property so that you can write that off against the rental income or you know, any kind of capital gains there. All right. Next up, this is an unusual one I want to kind of bring up. It's a very underutilized loan program. And it's called Homestyle or Choice. FHA also has a product called the 203K, but that has to be a primary residence only. Now, Homestyles is the Fannie Mae product. Choice is the Freddie Mac. But what this program allows for, it does allow for investment properties, but you can buy the home and roll in the cost to repair and improve it. So basically you have the purchase price plus the cost to repair and improve it, plus some of the added closing costs that are associated with this specific loan. And we roll all those numbers together and call that an acquisition cost. Then, based upon that acquisition cost, you would need to put at least 15% down. But when you step back and look at it, you're like, well, okay, I just financed 85% of my renovation cost. I just financed 85% of the purchase price. So another great alternative instead of hard money, because this is Fannie Mae, Freddie Mac, and you're going to get a good interest rate with it. So just something to think about there. What are some of the downsides of that one? Still, it's Fannie Mae, Freddie Mac, cannot put it in an LLC. Again, it's Fannie Mae, Freddie Mac, so we're going to have to get all the income, all the asset documentation to qualify. And then one other component here is when we look at the renovation cost alone, that cannot exceed 75% of the acquisition cost or the as completed value, whichever is less. So if you have, where that's going to become a problem is if you buy a property that's very low purchase price with a very high renovation cost. So let's just say you bought a property, for 30,000 and you're going to throw 150 into it, and the property when you're done is 190. Well, the 150 is going to exceed 75% of that future value. So that would not be allowed. So just some nuances to that. But if we're talking to a new investor, and let's just say you did not have a primary residence already, this type of program is a great way to start building up a portfolio, because now you could come in and buy a home as a primary residence, do it either as the Fannie Mae or Freddie Mac or FHA, put very little money down. I mean, 3.5% on FHA, possibly 3% down on the home style or choice if you're a first-time home buyer. And then you do the renovation, the renovations get done. We're going to come back to that in a minute. But then the renovations get done, okay? And let's just say it takes 5 or 6 months to do that. And then, so you've made your 6th mortgage payment. Typically what ends up happening at that point in time, 9 times out of 10, I am able to come back and refinance that loan. Even though these loans are 30-year fixed, we don't have to refinance them. But a lot of times A plus B doesn't equal C, meaning purchase price plus repairs and improvements don't always equal the property value. A lot of times there's a lot of built-in equity just because you went through the process of fixing it up. I'm sure you guys know what that's like with renovating properties. So a lot of times, like I said, we come back and I refinance the property. Now that the improvements are done, everything's done, the home's worth more, and we refinance it. Possibly you put 3% down, or say 5% down, and you made your 6 mortgage payments, all the work's done, and we can come back and refinance you. Well, now maybe you have 10% equity position, 15 or 20% equity position, and we maybe get rid of the mortgage insurance. So, and this has happened before. I mean, you put 3% down, you've made 6 mortgage payments. Now you've got 20% equity position and you're not having to pay mortgage insurance. I'm refinancing it again as owner occupied. And then maybe 3 or 4 months down the road, well, now maybe you want to do this again. Well, you've just refinanced this property without mortgage insurance at the lowest rate you possibly can, because now you've got a good, 20% equity position and it's owner occupied. Well, I can't stop you from moving out of that home. So now maybe you go to another property. Well, I want to buy this one and live in this as your primary residence. As long as you kind of keep moving up the ladder in terms of property values, that's wonderful. And you keep building this portfolio of owner occupied interest rate loans. Okay, so it's just a unique way to build a portfolio for someone that's just kind of starting out. All right.
And you're keeping the prior properties in that regard, or you have?
Yeah, in that scenario, right? You're keeping and retaining for rental purposes. Yep.
Yeah. And what are there any other?
Go ahead.
Yeah, are there any other restrictions? This is a very interesting program. I'm surprised I've never heard of it. Like, I feel like, why aren't many first-time home buyers or secondary home buyers doing this, where you're basically financing repair costs at a 30-year rate?
Yeah, it's 7.5 rate, 7.5%. Absolutely.
Instead of going to most people buy the home, then they go for a HELOC to do renovations, or they save up for it. It's a very interesting option, but it's unfortunate that since it's through Fannie Mae and Freddie Mac, you can't do it in an LLC. Right. So I'd love to know kind of what the options are if you wanted to do this from an LLC perspective.
Again, if you're going to go this path, you would have to be talking to your financial advisors and insurance people to see could you be protected with an umbrella as opposed to, and keep it in your personal name as opposed to going into the LLC.
No, I don't want to do that.
And again, I don't know the tax benefits that you would have, instead of having it on your Schedule E, doing it in an LLC, how that would benefit you differently. But something to look at and pursue.
Yeah,
go back to your first question of why you don't know about it. Well, there's probably, I'm going to guess, 15 to 20 loan officers in the entire St. Louis area that know how to do this program well.
Oh, okay.
So
Yeah.
you're talking to a mortgage person, especially any bank, no bank will do this program. And so if you're talking to, or, again, USA Mortgage, there's probably, I don't know, 300 of us nationwide, and there's probably only 15 to 20 in our company nationwide that do this program and do it well.
Yeah,
That's why you're not hearing about
that
it.
makes sense.
And this is for owner occupant only.
Well, this one actually could be done as home style and choice allows for investment property
Okay.
and second homes.
Okay.
Second home, yeah. So
Yeah.
exactly, yeah. So you keep your primary residence. So if I wanted to buy a house, a second house, a lake house or something like, especially a fixer upper, this is an ideal scenario.
Perfect scenario.
Find the
Yeah.
right person,
We're gonna
yeah.
talk more.
All right. The downside, let's talk about, I'm always about the downsides as well. Besides the LLC, the downside is you do not get to do the work yourself. You have to hire a general contractor. You have to have a general GC. So
You
you
can't-
cannot be the GC. Now, I have found out recently here that Fannie Mae and Freddie Mac, we kind of have potentially a workaround that if you had a family member that was a GC, that would be allowed. FHA will not allow that. You can't have a family member. Now, how do we look at that? Is the general contractor have the same last name as you? We're not doing any kind of blood test or genealogy trees or anything like that. If we see the same last name, we're going to question it. FHA won't allow that. But conventional, I just had one the other day that they are going to allow the GC. And it makes more sense in a sense. I mean, when we're doing one of these loans, we got to make sure whatever money we set aside for these renovations, the house gets completed, right? There's no going back and doing a second try. So, with one respect, let's just say you're kind of handy, right? And you can do some of the work. Well, I can't do anything. I can do this loan, but you don't want me working on your house, okay? So we can't discriminate. We can't just say, well, yeah, you probably know how to do flooring and some minor electrical and plumbing. But or Jill can't, we can't discriminate. We can't make that choice of picking and choosing who we would allow to do some of the work or not. What we're doing is we want a general contractor, because if they don't get the work done based upon that bid, then we're coming after them. They're going to get sued. So we can't let someone say, well, I'm going to watch a DIY video, and I think I can do it. Well, for me, I'll screw up 2 or 3 times before I get it right. And now our money's gone and we can't get all the work done. So that's why there's the need for the general contractor. Any other questions on that program? I love the program. I actually teach this as a CE class to real estate agents at the St. Charles Board. Because again, I'm just trying to get the word out about this program, because 99% of loan officers out there are not going to talk about it.
So Steve, on that question, so what is the purpose of the home style or choice? What was its intention, right? I know we use different purposes. What's original intention of that?
The intention is to rebuild communities. So homes that are, just never been updated, they're worn out. They want to try to get them regenerated, rebuilt up. And so whether it be, again, the home style and choice programs, they only came out about 6 or 7 years ago. FHA's 203K has been around for a long time. So Fannie Mae and Freddie Mac came out and said, hey, we want to try this. And so they came out with the program to compete with the FHA. But the FHA originally, again, well, and still, you have to be a primary residence. So when Fannie Mae and Freddie Mac came out and said, well, we want to try doing this, well, Fannie Mae and Freddie Mac will insure or buy the second homes and investment properties as well. So they included that in their program in terms of being allowed to do those additional properties besides primary residences. But it all really started with primary residence, because home ownership, one, it's the greatest way to grow wealth, and also to rebuild communities. A primary residence, a person's going to take care of their home better than a renter is going to take care of a home, right? So again, all about rebuilding communities. That's the pathway.
Thank you.
And again, most people, especially nowadays, don't have the money for 5, 10, 15, 20% down, plus the closing costs, plus these renovations, right? I mean, well, I'll be point myself out. When I bought my house 18 years ago, it had an unfinished basement. I really wanted a finished basement, but I didn't do this program myself. But, 10 years later, then I got a basement finished, but had I, thought through it, maybe said, well, let's just do this right out of the gate, I would have had a finished basement 10 more years of enjoyment versus waiting because, it's just, saving up the money and all that, just kind of getting around to it. That was, I,
Is there any restriction? Does it have to be a single family or can it be?
no, you can do 2-family,
Two family?
4-family.
4-family,
Yeah.
okay, yeah,
Nothing more than a 4-family.
right.
But that's a great program right there, especially for a first-time home buyer that doesn't own a property. What if you bought a 4-family flat in the city? You're gonna live in one, you're gonna fix all 4 up, rent the other 3 out, pay it, making your mortgage payment for your property as well. And then maybe after 6 or 12 months, I want to jump out and do it again, buy another 4-family. And you're building up all these units. So it's a great program, very underutilized. This one, I'm not going to delve too much into it, but for those that are over the age of 62, there's a reverse mortgage or HECM possibility here. And so what can happen on that is you could do a reverse mortgage. It's an FHA insured loan, so it has to be primary residence. So you could do a reverse mortgage on your primary residence, possibly, use that to, let's just say your property was free and clear. Do a reverse mortgage on it. You don't have to make any payments on a reverse mortgage, okay? So you have no payment. You take the equity that you got out of your reverse mortgage, and then you could go out and pay cash for an investment property. Again, you're paid cash on your investment property, so you can put it in your LLC's name, and then and then in terms of you don't have to make that principal and interest payment. So there's no required payment. You can if you want, but you don't have to. That's actually a great program for a second home.
Can I ask some questions about the reverse mortgage?
Absolutely.
The first one is if you go into a reverse mortgage and you want to come out, it's been years since I've had information on this. How do you get it back? And if you happen to pass away with the reverse mortgage in effect, how does your family obtain the property?
Absolutely. Great question. So first thing is a reverse mortgage is the exact same thing as a forward mortgage in terms of how it's being dealt with by the investor. Okay. So if you had a regular mortgage on your house and you pass away and you leave it to your heirs, well, your heirs either have to sell that property and pay that loan off or retain it and pay that loan off. Okay. They can get their own loan, but they got to pay off your loan. Okay. Same thing for a reverse. The only difference is if you're not making mortgage payments, the loan balance is going up versus you making your payments and the balance is going down. So same situation, you pass away, you leave it to your heirs. Your heirs will call up Jill and see what's the property worth. And she tells them, and then they call the bank and say, how much do they owe? And if there's equity left in the house, Jill will sell the house and they would keep the difference. Just like any other mortgage on a property. Now, the beauty of this program is it's a non-recourse loan, meaning let's just say you live in that house for 30 years with a reverse mortgage, and that loan amount keeps growing and growing and growing more than what the property is even worth. So you're upside down in the house. So now you owe $600,000, and that property is only worth $500,000. Well, your heirs find out that Jill can only sell it for $500,000. The bank says that you owe $600,000. So then they just say, okay, bank, where do you want us to send the keys? And they just turn the house over. And then that $100,000 that it's upside down, HUD steps in and pays the bank that $100,000. It's a non-recourse loan. You could have $1 million sitting in your checking account and the bank cannot come after anything else. No other property, no other accounts. They will sell that property at whatever the loss is, and HUD is insuring that loan and will pay the difference. So I know that was part of the question of what happens with it. Was there something else that I did not answer to?
No, you covered both of them.
Okay.
Thank you.
One more thing with that, and I know we'll get off the reverses. That's another passion of mine. I specialize in the renovation loans and reverse mortgages for our company. But on the reverse mortgage, there's a third option. So again, we sell the house, it's upside down, sell the house, and HUD takes the loss. There's equity, they sell the house and keep the equity. And the third option is if one of your heirs, has to be one of your heirs, wants to keep that house, buy it back. They actually get to buy it back at 95% of what the property's worth. So when in a situation where the property is upside down, like again, you owe 600,000, property's worth 500,000, that one of those heirs could buy it back at 95% of the 500,000, and HUD would then lose more than that 100,000. They would take a bigger hit on it. But that is one of the clauses in a reverse mortgage. An heir gets to buy it back at a 5% discount.
What if you have a beneficiary deed on your property for a family member?
Yeah, that's fine.
Okay.
Yeah, all that happens after your death, right? So, you know, none of that's going to take place now. Or if you had a trust, you could do a reverse mortgage in the trust and put it in that way. So, all right. Any other questions? I mean, you can get in touch with me on reverse mortgages. I can talk all night on that one, but I want to get into some of the other things here. So now the non-QMs. This is the ones I think you guys are really wanting to talk about. The biggest one in the non-QM world right now is called this DSCR loan program. It's debt service coverage ratio. So basically what that says is, I don't need anything from you. I mean, I need assets because you got to show me that you got enough money to close. But if you wanted to buy a house and whatever you're going to rent it for, now there's different ways of coming up with what are you going to rent it for. It could be a lease that you have pre-signed, or maybe the property already has a renter in there and we have a lease already. If it's vacant, then they're going to, you know, the appraiser is going to come up with what's called a rent schedule and figure out what rents are going for in that area for that type of property. And so they're going to come up with a number of say, well, this property could and should rent for $1,000. Well, if you're, I'm going to jump to the next one here. So if you're a 1-to-1 ratio, meaning your mortgage payment, and we're talking about principal, interest, taxes, insurance, and any HOA fees, if that payment was also $1,000 and your rent's $1,000, we're calling that a 1-to-1 ratio. And that's great. All we got to do is prove that and your deal's done. That's it. Simple, easy. Now, what if the rent comes back and it says, well, it's really only worth, only going to rent for about $850 and my payment's $1,000. Well, that still can work. You know, there's companies that will go down to the 80%, 80-to-1 ratio or 0.8-to-1 ratio. Typically, you're going to see differences in maybe loan to value, or maybe you need a higher credit score. But that's also, you know, a possibility. So we're just a little bit off. But let's just say it really comes in low, and you're only coming in at $700 and your mortgage payment's $1,000. Well, then again, it's possible still to do it, but you're going to have to put more money down. May need to put 30% down. And you're going to have a higher credit score, or, you know, like 65% loan to value. But there's also other options. We could jump this over to what's called a no DSCR or a 0 DSCR, or you could do, you know, there's another way to play with the numbers here. What if we took your mortgage payment, that's $1,000, but we took it to an interest only program, and now you saved or shaved off the principal, which was $400 or $300. And so now that brings your $1,000 mortgage payment down to $700, and your rent schedule that came back said it was $700. Now you're back to a 1-to-1 ratio. So there's ways of playing the game here to get those ratios in line if in fact the rent came back lower. Now I know rent's kind of through the roof, so I find it hard to believe that a property wouldn't rent for what you're, you know, and when you're looking into these properties, I'm sure you're looking at what the rents are going for in that area. So more than likely, you're already understanding that, you know, you're probably pretty good on this one before you even put it under contract. But I'm just saying, should something come back a little bit off, then we can play with the numbers to get it down, or, you know, maybe shave a little bit off on the homeowner's insurance to get the number down. So there's ways of playing that. You can also go out on a 40-year term instead of a 30-year to get the payment down. So things to do there to work with that. Now, again, there's no income or employment required. And then the qualifications, meaning credit score and down payment is going to be based upon the property cash flow, that ratio. There's no limit to the number of properties financed this way, so that's great. You can do this, as an LLC, and that's one of the biggest features of this, that you can do it in an LLC, S corp, revocable trust. Again, you can do an interest-only option on that. Gift funds are okay. These programs also allow up to 6% seller concessions. Now, I'm giving some general guidelines here. There's probably, we would probably work with 30 different companies that specialize in these non-QMs, and every company is going to have a different little nuance, okay? Maybe the property has to be greater than 600 square feet. Maybe it has to be greater than 700 square feet. The loan amounts, typically most want your loan amount to be at least 125 or 150, and then there'll be some that'll be, okay, we want it to be at least 100. And then maybe we have one or two that will go down to 75,000. But for those lower property values, I don't have anybody that really will go below the 75,000. Maybe a little bit on an exception here or there, but not as a normal. But so a lot of this stuff is just general kind of guidelines, and again, we can talk afterwards if you want to kind of drill down on more specific. Another thing why this program might pop up, especially for an investment property, let's just say you're going to do a Fannie Mae, Freddie Mac condo, and you're going to rent it out. Well, that's perfectly fine. Whoops, we get the condo questionnaire back, and we find out it's a non-warrantable condo. Now, what are we going to do? Well, we just flip it over to this type of a program, a non-QM. I'm not saying necessarily a DSCR, but we run it through one of these non-QM programs because they're perfectly fine with non-warrantable. Even down in Florida or something like that, you could do a condotel. So those are allowed under this program. And then, dependent upon, again, loan to value, they may require some reserves, meaning, do you have any money after your down payment, after your closing costs? Do you have money? It does not have to be liquid. You don't have to get it out of a retirement account. You just have to be able to show that you've got money. If push came to shove, you could get access to some additional funds if you needed it. So those are what are called reserves. And again, going back to the scenario of if your mortgage payment was $1,000, well, that $1,000 would be considered as 1 month reserve. So if the program said you need 6 months or 12 months reserves, well, you would need $6,000 or $12,000 left over somewhere to show that you have those reserves for the loan. And then again, these DSCRs, dependent upon the lender, the servicer, you could be a first-time home buyer and even first-time investor. A lot of these companies don't want the first-time investor because they don't want them to kind of be the guinea pig with a first-time investor, and whether or not, you bought right, did you overpay, are the rents going to cover, what if something goes out and now you've got to pay for a new furnace, did you account for that in your money, because the rents, you haven't made enough in rents to cover that. So a lot of the investors won't do first-time investors, but we do have some. Any questions on the DSCR, and have you guys heard about that program?
I actually haven't.
No?
Mm-mm.
Okay. That's the biggest one going right now. That's the buzzword is DSCR. All right, bank statement programs. So now this one is requiring some additional paperwork, right? DSCR, it's kind of like back in the subprime days, it was a no-doc program, right? You're not giving anything really. Well, this one you're giving documents, and it can be your personal or business bank statements, typically 12 or 24 months. And they're actually looking at every statement, every page, and they're going to add up every deposit, whether it's on your personal account or your business account, and they're going to say, oh, they deposited $3,000. Oh, they deposited $2,000. Oh, and they're going to do that for the 12 or 24 months and then divide by 12 or 24. And that is now your monthly income. Now, for a personal bank statement, they're going to take 100% of those funds because, again, not exactly sure where it's coming in from, but if it's coming into your personal bank account, you can use 100% of those funds. And so that's why they're going to give you credit for 100%. But maybe, like I used a program on a owner of a bed and breakfast in California, or a restaurant in California, was buying a bed and breakfast in Hannibal. So he wanted to, well, it was a house that was going to turn into a bed and breakfast, but for the house, we were going to do a bank statement program. I mean, because on his tax returns as a restaurant owner, he was barely clearing, he reported taxes on $36,000 a year, okay, in California. Well, I'm looking at bank statements and the guy was pulling in $40,000 a month on his business bank statements. So we just went that path with the business bank statements. This guy's making $40K a month, and we were able to get it done that way. So again, great program. Now, again, when we did more paperwork than the DSCR, but we're nowhere close to what a Fannie and Freddie would be because it wouldn't have been done. The guy only made $3,000 a month on his tax returns, so I would not have been able to get that done on a Fannie Mae or Freddie Mac loan. On the bank statement program, some of these investors will do, again, 15% down on an investment property utilizing the bank statement program, which is great. But there is a little nuance. They do want to make sure that you're 2 years self-employed. If we're going to use bank statements, well, we don't want a W-2'd employee using a bank statement program because you already know what you make. You can see it on a pay stub. We can see it on a W-2. It's for the self-employed people because, again, there's a lot of stuff that can be done on tax returns that says, yeah, I made $1 million, but really, I'm only showing I made 40,000, in taxable income. And so that's why they want a 2-year self-employment history. Also, if we're using bank statements, depending upon whatever that business is, what type of business, they're going to come up with an expense ratio. Like maybe and again, I'm just pulling numbers out of thin air. Maybe for a restaurant, it's a 50% expense ratio. So maybe even though I showed 40,000 coming in on a per month on a business bank statements, they're only going to let me utilize 20,000 of it because they know he can't, just because the money's coming in for the restaurant, there's food costs, there's labor costs, there's all these costs built in that we know. So that's why there's going to be an expense ratio. All right. Any other questions with that? Okay. Now I'm just kind of going to lump some different nuances or programs kind of together here. So again, there's a no ratio program. I'm actually working on one of these right now. So this is for a primary residence out in Lake St. Louis. I tried every which way for this buyer. The borrower was a veteran, but he did not qualify for VA. He did not stay in there long enough to get his VA benefits. So I couldn't go VA. Conventional, we couldn't. He lost his job in July. He was in IT, lost his job in July, so we don't have W-2 income. And then she started a business selling the flavored oils, we can buy for cooking. And so she was doing it online. Now she's going to open up a storefront. Well, that company's doing nothing right now, but they have a lot of money. I don't know if they inherited the money or what, but they've got about 750,000 sitting in Charles Schwab. So again, there's we'll get to some of this asset utilization. So I was looking at asset utilization maybe as well, but for most of the programs, they didn't have enough assets because we were going to need about 180,000 for their 25% down plus closing costs. And so most companies want a lot of money left over if that's all we're looking at is assets here. And for most of the companies, the asset utilization wasn't going to work. But now I've got a company that came back and said, they're going to look at it. Right now they're looking at it tonight. I'm going to get an answer tomorrow morning on whether or not they're going to allow this borrower with no employment, no income, put 25% down and show that they got a lot of money left over and whether or not they're going to do it. And that's, as bizarre as that sounds, that's the types of programs that are out here. Now we've got another one, which is the profit and loss, P&L. If we were utilizing just a P&L on Fannie and Freddie, that has to be an audited profit and loss. And why would that come up? Well, we're now in 2025. your tax returns for a business and personals are probably 2022 and 2023s if I'm looking at the last 2 years, because no one really has done their 2024s yet, right? Well, I can't go from 2022 and 2023, how you did in your business, and totally skip 2024. So a lot of times we're going to have to get a profit and loss on 2024's income because I got to see how you did. I can't just not look at it. Now, sometimes it may need to be an audited one. What we're talking about here does not have to be audited, but it does have to be prepared by a CPA or licensed tax preparer. We can't just let you go out on Excel and type up a profit and loss and take that. It does have to be a tax preparer that puts their eyes on that. But on that case, you don't have to give any additional documentation. There's no additional bank statements needed for income verification. And let's just say, why would I do this versus a bank statement program? Well, it's based upon this one, a pitfall. What if I look at your bank statements and I see, a one-time drop in of $100,000, but most of the time the banks, the deposits are 2 and 3 and 4,000. Well, they're going to want to know what was this 100,000 about, and so that could become a problem. Or if your personal or business bank statements have insufficient funds, they're not going to want to do that program. If you're, constantly seeing NFS is popping up on these bank statements from time to time, means you're running out of money, and that's not a good thing. I mean, if we're basing a loan off of your bank statements and you're running out of money and you don't even have this loan yet, that's a problem. So if something like that would pop up, I would say, well, maybe we need to look at the P&L scenario or a no ratio program versus going bank statement. Now, again, the asset utilization. It's looking at the assets, and there's different ratios of what we're going to use. Anything in a checking, savings, or money markets, we're going to use 100% of those. Again, those are liquid funds. They're sitting in your account. You have full access to those. So you get 100% credit for those. But if we go to, maybe some stocks or bonds, well, market fluctuates, right? I mean, every day the market's up and down. So they're going to want to do a conservative number there and only utilize 80% of those of that account. And then if it's the money's in a retirement account, they're going to ding it another 10% because there's a possibility of a 10% penalty to withdraw those funds. So that's why they're going to ding that a little bit more. There's programs that are, for bridge loans or fix and flips, in terms of you can do up to 90% loan to value on a purchase with renovations, up to 100% of rehab financing, and even 80% for a non-experienced investor. So again, those are going to be a little trickier. Not all companies are doing those. So the less companies doing a program, the more little loopholes, nuances, gotchas can happen on those programs. So all these programs, I mean, it's like working a Rubik's Cube, you do one move and, but I forgot about that one. And so you're trying to constantly figure out which is going to be the best, servicer to go with that your particular scenario fits. And then the interest only, that can be attached to pretty much most of these non-QMs. So you can do a DSCR, interest only. We could do a bank statement, interest only, a no ratio interest only. So we can mix and match some of these as well. Typically when you have these layers upon layers, what we also need to be thinking about higher interest rate, higher interest rate, higher interest rate. So, but if the program fits, I can guarantee you it's not going to be 12 or 15% that a hard money guy is going to charge. So when I'm talking about higher interest rates, I might be going from, a Fannie Mae, Freddie Mac might be, if you're putting 25% down, you might be in the upper 7s. And if we were doing an interest only, no ratio, you might be doing 35% down at 9%. So, just got to kind of take it, as it comes and see what best fits your needs when trying to do the financing. So again, to kind of wrap things up, when we're sorting through these options, kind of questions I'd be asking, or you would want to, ask yourself is, what is our intent? Are we going to buy and hold, or are we flipping? That's going to be number one, because if we're flipping, you can't even do a Fannie and Freddie. We won't do it because we're going to get hit. If I close a loan and you turn around, fix it up and sell it in 60 days, I get burned by Fannie and Freddie. Okay. I have to pay them a whole lot of money because you sold the property too soon. So if you're not holding the property for, I'd say 6 months to a year, Fannie and Freddie really isn't going to be an option. And then, are you holding it for, and renting it and getting your appreciation, cash flowing? Again, the cash flow piece would be with the DSCR. How much money you putting down? Are we trying to do 15% down or 25 or 35% down? Big one is ownership. Again, if you're thinking LLC, sole proprietor, something like that, Fannie and Freddie are off the table. So now we have to be thinking about the non-QMs. And then how can you qualify? Again, if you can show the income to, have the debt to income ratios work, you've got the assets that you can show. The more you can show, the better the interest rate, better the terms, better the loan to values, all of that. But if you can't show it, you're going to pay, kind of a pay to play type of thing. If you can't prove something, you're going to pay for it then in a higher rate or higher down payment or a combination of the two. And then credit score is always going to be play on this. A lot of, we'll see them go down to maybe 600, but at 600, you're going to be putting a lot more money down than say a 720. So want to make sure that credit scores are good when you're wanting to do some of these non-QMs to help with that interest rate and down payment. That's it though. Any questions?
So did we talk about 1031s?
Oh, I'm gonna 1031s. I'm gonna kind of let Jill talk about that a little bit more
Okay.
because 1031 on my side, the 1031 is the piece of I'm gonna swap out paying taxes now to kicking the can down the road to another property, right? So we're just parlaying that equity over to another property. For me, on my side, I'm just looking to finance that new property based upon whatever equity you're pulling over. Well, that's just your down payment now on the next property. And I would just be looking at doing a Fannie Mae, Freddie Mac loan on the new property. But the 1031 exchanges is in Jill's world.
Okay, you can hear me. Okay, so 1031 on the real estate side is that how it works is that you selling a property to move that money forward to another property. Now, you don't have to move 100% of that money to the other property, but you will pay tax on the part that you keep. You can roll it over to one property that is more valuable than the property that you're selling. You can move it over to multiple properties that are more valuable than the property that you are buying. And it doesn't have to be an extraordinary amount. Actually, it can be equal to or above. You want to go above because you want to make money on your 1031 exchange. But the rules are that once your property goes under contract, once you close the first property that you're selling to roll over to another property, you have 45 days to designate that other property. In the meantime, whoever you designate as the facilitator of the 1031 exchange, typically that's a title company that sets up an escrow and holds those funds for you to roll them over to the next property. Whoever you designate, they will hold those funds, but you have 45 days to designate the other property. You have 90 days to close. So that if you got a first property and it fell apart during inspections, then you have time to find another one, but it's really not that big of a window. 45 days is not that big of a window to find a property. So typically what I would say is we would start looking for those properties and designate those properties before you close on the first property with a close date farther out than what you're closing on the property that you're selling now. So really that considering that a typical close from contract to close is 45 days, you've got 90 days built in plus 90 days once you close to close. Does that make sense?
I want to specify it's 45 days. If you found the property in say 44 days, you only have 46 days still to close, or do you?
Correct.
Okay,
Yep,
so it's
a total
cumulative,
of
it's a
90,
total.
total of 90 days. But you have 45 days that you have to designate what property you are going to buy. So again, that 45 days goes away very quickly. I would not wait till the day that you close selling your property to start finding a new property, because then it's just a scramble. But I would make sure that you are through your inspection period and that you've solidified, even waiting until the loan commitment of your buyer is done, then you're pretty much guaranteed that you're going forward. You can make it contingent upon the sale of the property that you're selling. That's okay. That's not as competitive, but it is a safeguard. There are lots of safeguards that you can put in if you're wondering, oh my gosh, well, why would I want to get myself under contract with something if I haven't closed yet? Well, time is of the essence, and there are safety valves that we can put in place to make sure that you are secure. Did that answer your question? Do you have more questions about that, Linda?
No, I guess I mean, I kind of already knew all that information. I was looking for further expertise, like in just other things, not just the requirements, but any experience with people doing this, I guess.
Yeah, I've done several of them. I mean, it's really not any different the transaction than any other transaction. You just have that stipulation of let's get it done. And I've done it where a person has sold one and bought one. I've done it where they've sold multiple and bought multiple. Now, one of the clarifications I need to get on that, because when we did it, we sold multiples and bought multiples. They had the closing at the same time. So I don't know if you'd get a varied closing time if you had multiple sale dates. And you can do multiple 1031s at a time if you have a problem with the sale dates.
And my understanding is with the 45 days, it just has to be a list of potential properties that you might go to. You know, it's not like you have to have one under contract.
No, but you have to designate it. So if you're going to designate 4 or 5 properties, you got to buy one of those.
Yes, and I get that part.
Yeah,
Yeah.
yeah.
And you said something, I do have one question, because you said something about you wouldn't want to just buy a property for the same amount that you're selling, which was my intent. I would love to do that if I could find one that was
Yeah.
only. What did you mean by that?
You can, but I mean, if your whole point is to grow, then chances are you're going to go up because you have more cash available, more funds available. So why wouldn't you go from a 200 to a 300? You know,
Well,
if
because
time allows.
I don't want to have to outlay, in my particular situation, I don't want to have to outlay any more money if at all possible.
Yeah. You're still gonna have to have closing costs unless you roll those in. But you can go the same value. If you wanted to go lateral, you can go the lateral. It doesn't have to be increased, but it can't be less.
Mhm.
Yeah.
Well, if it was less, they would just get taxed on the difference.
You'd get taxed on the difference. That is correct. You can go less, you get taxed on the difference. You can go less if you're doing 2 properties because the total value is more, you know, those kind of things. So there are ways to work around it, but you can stay the same level if you wanted and not pay taxes. Okay, any other questions?
I do, this was Steve. So
Mhm.
Steve, you know, in regard to the non-QM option, so if we come to use, hey, Steve, now, we're interested in get this product for, you know, either short term or long term. And you will run through the different options to find out which one will be makes most sense for us, right?
Correct.
Okay.
Yeah, based upon some of these questions I'm gonna ask. You know, how long you're gonna hold it and what can we document? Because again, the more that we can document in terms of income and assets, the better program and rate and loan to value I can get you.
Do you have any thought on how long it takes to close some of these different types of loans?
I would typically say you know, I mean, for a regular Fannie Freddie, I can get them done in 3 weeks. With these kind of programs, I just hate to say it, but I have no control over them, right? So it's more probably like 6 weeks on those. It depends though. I mean, the beauty of that DSCR, I mean, literally, I can get you in a pre-approved kind of status, meaning, you know, basically, so once you find that property, all we have to do is get the rent pulled in and we're done. So on a DSCR, that one can be very fast. It's just, I want to kind of give a little cushion there. If we're doing a bank statement, you know, one of the other types of programs, but DSCR can be very fast. It's just whether or not we have to, if the number came in low and now do we need to try to fight it and use some other sort of rent number? Or are we going to try to play around with the interest only, things like that? But I mean, if it comes back good, we're, you know, ready to close.
So with that DSCR, let's say your rent is at least as much or more than your payment. Are you gonna see you're gonna have to pay a higher interest rate, or what's the
No,
run on that?
no, I mean at that, because now you're at least a 1-to-1 ratio, so you're going to get the best loan to value and the best interest rate because they're saying that, yeah, you're bringing in 1,200, your payment's 1,000. Woohoo, great. You know, so that's great. I mean, but again, it's a non-QM, so we're not going to be talking about, well, I mean, some of them, if you're putting, you know, 35% down, I mean, there's times where it's 6.99. I mean, it's lower than what I could get on a Fannie or Freddie, but that's putting a lot of money down too. So these don't have to be crazy. Where I'm going with that is they don't have to be crazy high interest rates. I just like to prep people that they're going to be, you know, maybe in the 8s, but depending upon loan to values, if you're putting a lot of money down, they could be in the 6s.
Is that about, I guess I'm just thinking about, well, just because I'm gonna be in this situation where I'm selling a property and potentially doing a 1031. And the property's paid off. So I'm gonna have a lot of money to put down on other property. But if I was gonna go bigger, like Joe was talking about, where I still owe money because the property I'm buying is more expensive, would we be looking at just regular loan, do you think, on that?
I always try regular first, right? Because I want to get you the best interest rate. Absolutely. But it's just, again, sorting through these options and asking the questions up front is, you know, can we prove income? I mean, if you're buying a 400, you're bringing 250 to the table. Can you afford 150 based upon your regular income or tax returns? If you have, you know, multiple properties and you're cash flowing on your other rental properties, if that's your income and you can afford 150,000, well, great. Let's do Fannie and Freddie. Or maybe you're like, well, Steve, I don't want to mess with all that paperwork. I'm gonna probably pay this thing off in 3 years or 5 years anyway. You know, that's fine too. People sometimes just don't want to mess with all the paperwork. And I get it. I mean, it's Fannie and Freddie are going to ask for everything. So it's just asking those kinds of questions, going through that process. Anybody else?
Steve, are you
No.
gonna make these slides available for us, or this is
Yeah, we're recording this.
okay?
So I'll send out everybody a link we're gonna put it on the YouTube and on the website, so you'll have access to this to go ahead and watch it again.
Okay, good.
Okay, well, I think we're about ready to wrap it up. I really appreciate you attending. I hope that you got a lot of valuable information. Steve, I thank you once again. He's been such a pleasure to work with. And if you need a lender, look up Steve Mormon, USAA Mortgage. Definitely worth it. All right. Good night, and I will talk to you all very soon. Take care. Thank you.
Thanks.
Thank you, Jill.
Bye.
Bye.
Nice to meet you too.
Yeah.